Today's show is brought to you by our friends at CraneShares. One of the most popular investing strategies over the past couple of years has been covered call strategies, particularly in ETFs. They blew up over the last, 12, 24 months. We've spoken about the CraneShares China Internet ETF before a million times, KWEB. There is now a covered call strategy on that. The ticker is KLIP. That's CLIP. If you would like to learn more about the fund, visit CraneShares, that's with a K, .com/clip with a K.
All right, 93. This is going to be one of the biggest shows. This is going to be one of the biggest shows we've ever done.
No pressure.
No pressure at all. But I have to say, we are so blessed to have the guests that we have in the house. And I actually want to give Michael the microphone to do our introduction.
You shocked me. All right. Oh, the future-proof introduction you said?
No, listen to me. Introduce our guests.
Okay. We've got Morgan Housel. Everybody knows who Morgan is. Let's move on to Chris. Only kidding.
That's not an introduction.
I'm only kidding.
Okay.
Morgan Housel is a partner of the Collaborative Fund, but most notably known as just the best financial writer of our generation.
That was literally the title you gave Ben Carlson.
Well, no, Josh said that. I never said that.
You know what I did? I said Ben is the best financial writer of his generation.
Okay.
And you are the best financial writer of yours.
Ben's got you by 3 years.
That's right.
Different generation, totally different things.
Is Ben Gen X then?
Yeah, Ben Gen X.
All right, so it's different.
You represent the millennials.
I'm an elder millennial.
So Morgan is the author of The Psychology of Money, which literally sold 2 million books.
3
million books.
2 million, please.
Not to rub it in. Come on.
Yeah.
So that's got to be honestly like a top 10.
Nobody sells 3 million financial books.
No, but that must be all-time top 10.
Yeah, I think it might be for finance books. I think it's.
Well, what are they? Is it Rich Dad?
Rich Dad, The Intelligent Investor.
Napoleon Hill?
Napoleon Hill. And
dude,
I think it's right.
You probably sold more books than Security Analysis. Securities Analysis? Is it Securities?
The Intelligent Investor.
No, forget about
there
that. That's different.
Well, nobody bought Securities Analysis.
Right.
It's a tome.
Yeah,
no one reads that
textbook.
one.
Yeah. No, but people bought it. Nobody read it. But anyway.
But you're like in pop. You're now part of pop culture. Like it's crossed out of financial book. It's book. That's what I'm saying.
May have pushed out Ben Carlson as the writer of the generation.
Oh my God.
I'm kidding. We love Ben.
Go easy on Ben.
And wait, Morgan's got another book that is out for pre-order. You just have to wait 4 months. But in November,
or 8 months or whatever.
What's the title?
It's called Same as Ever, and it's about the behaviors that never change over time. So just like what people have always been doing that they will always do. And I think there's so much focus on change.
You rewrote *Sapiens*? What are we saying here?
It's not quite as broad as *Sapiens*.
*Sapiens* for kids.
But there's this.
No.
I just think there's so much attention.
Is that what you did?
It's called *Little Sapiens*.
All right. No, I like it. It's a good idea for a book.
It's just like there's so much focus on everything that changes.
Yeah.
And just looking at it's just 23 stories about things that never change.
Okay.
Like what people will always be doing.
So that's going to be ready for what? Like the fall or Christmas?
It comes out November 7th.
Perfect.
Yeah.
Okay. All right. We'll make sure that we link out for the people that have not yet read Psychology of Money. My wife read that. She hasn't read an investment book ever. And I said, "What made you pick that up?" She said, "I don't know. Like you always talk about Morgan, and I like the cover and his picture of a brain, and I wanted to learn something. That's the secret. You didn't do a picture of the stock exchange.
No.
You didn't do a picture of like somebody trading on a keyboard.
There were 50 iterations of the cover though, and all of them were that until number 50 that we can.
But that's a big part of crossing over.
Yeah.
Is like the cover.
Yeah,
it's so
it's
obvious.
Really important. They're like, don't judge a book by a cover, but everybody does.
Everybody
literally does for a cover. It's just like in a blog, it's the title. In a YouTube video, it's the thumbnail. Those things are really important.
Well, listen, we're proud of you. We're jealous and proud still. All right, Chris Davis is here. Chris is a chairman and portfolio manager for Davis Advisors, an investment management firm with over $20 billion in assets under management. That's underselling you, obviously. You are you're an eminence. Is that too much?
Oh, I like the sound of that.
But
I want to just say one thing about Morgan's book is that the reason that your wife loves it is because it's not an investment book. It's a book about how to be happy.
Yeah.
It's really a book about equanimity. And that's what's so powerful about it is it's the opposite of a get-rich book. And it sort of crept into the tent that way. And then people were totally misdirected.
Yes.
And then they realized, wait a minute. It's not about how I get the highest possible return. It's not about how I get rich. It's about how I find contentment,
And
how I
it's
get off the
stories.
crazy train.
And stories are so powerful. Like every chapter is at least one story. And
Yeah.
that's how people really learn. They learn from their own experiences, and then they learn when somebody tells them a story.
It's always the best story. Like
The Valet Parker one.
Right. How many formulas do you remember from the night before your test in college? Like
Yeah.
zero. Nobody. But how many? If you hear a good
the
story, you'll
janitor
remember
who
it forever.
accumulated stocks and never
Yeah.
sold.
Yeah,
like
it's
that.
simple.
These stories are important.
Not only do you remember it, but it's easier to contextualize your own life with that. Because
Okay.
I feel like in blogs, it's the same. Like Josh, you tell stories. It's if your blog is just a data dump, it's out. And even Nick Majuli, who is dollars in data, he's a storyteller.
Yeah.
And that's why his blog is great. It's like that. It's always like that. And there are a lot of good finance minds out there, like really technical minded people. But if you're just putting out charts and it doesn't, and you could even say like JC, he's a chartist. But he tells a story and he's got a personality. So like that's it. Even when it's
Boy, does he
pure,
ever.
even
Yes,
when
he
it's
does.
pure analytics, that's like the people that get ahead are the ones who tell the best
All right,
story.
and you are speaking at Future Proof this year.
Yeah.
Okay. Are you talking about the psychology of money,
I don't
or are
know.
you
I have
talking
no idea.
about?
You tell me.
We don't know
Yeah.
yet.
It's your
No,
event.
it's a secret.
Okay.
And
Hey,
Chris,
can we go back to the eminence part? Because we seem to have drifted a little bit here.
Chris, you're right.
I'll stay on
Chris,
task.
you're right. I want to read this. This is from the Davis Advisors website. I thought this was. I like Wall Street history. I'm really into this stuff.
He's just going to read the fine print.
Our firm traces its roots to past performance does not guarantee. Our firm traces its roots to legendary investor Shelby Cullum Davis, a leading financial advisor to governors and presidents who parlayed an initial investment of $100,000 in the late 40s into more than $800 million by the end of his career in the early 1990s. In 1969, Shelby Cullum Davis's son, Shelby M.C. Davis, founded Davis Advisors after serving as the head of equity research at the Bank of New York in order to offer the Davis investment approach to outside clients.
1940s.
And so you come along into this, and then you build on it, and the firm is still doing what it's doing, and that's like rare on Wall Street. You
Yeah,
guys
well,
have
I'm the
lived-
generation that usually screws it up. And
You're the third generation.
Yeah, shirt sleeves to
No
shirt
pressure.
sleeves, but it was interesting because my I think part of the peculiarity of both my father and grandfathers, they didn't believe in inheritance. They really had that view. Now, I was still born on third base.
Are you still bitter about that? Or are you?
Well, a little bit. He said, my grandfather said, I wouldn't want to ruin you. I wouldn't want to rob you of the opportunity of making a living. I'm like, well, you could rob me a little bit.
Yeah,
just a little.
No, but that's beautiful.
But and so they were very clear about that from the beginning. But they also said, we're going to give you, we're going to put you on third base. And you're on third base because your education, reputation.
What does Buffett say? Want to leave my kids enough that they could do anything, but not so much that they can do nothing?
Yeah.
Was that him?
That was Warren.
Okay.
I heard the story from Munger recently. Or one of his rich friends said, Charlie, he said, if I give all my money to my kids, is that going to ruin their ambition? And Charlie said, of course it will, but you have to do it. Otherwise they'll hate you. And I thought that's like the curse of it. But it seems like you guys pulled it off okay.
It sounds like there's a way to do it where it's like, I will give you the advantages that you need, but you have to do something.
Yeah. I mean,
Like-
was there any animosity when your grandfather had $800 million and you didn't get any of it?
Well, I was already working with him. I felt like I had been, and he gave me a passion for this vocation. I used to describe my father used to commute from Hoboken. He'd take the Erie-Lackawanna train out. He lived out in Tuxedo. Isn't that an amazing name? And, and we'd go down and meet the train, and it was a big deal coming in when I was a little kid. And these men would get off that just, when you think of those lives of quiet desperation, like gray, beaten down, getting off the train. And my dad would come out like just exuberant. And if he was driving us somewhere, we'd stop and see a company. And he never – it was a little bit like if you want your kid to learn French, you can like put him in French lessons and you can get a tutor or you could just go to France for a while.
Yeah.
And it was a totally different way.
You grew up in the lifestyle. And
seeing two generations that were so excited about what they did. My grandfather called it the best game in town, and he just loved it. So I don't think there was any. And I will say, and especially in case my father hears this, I don't want to be an ungrateful whelp, because my father really actually surprised. He has 6 children, and we were all completely flabbergasted when we got a letter from him about, I want to say 3 years ago, and he said he had actually set up trusts for each of the 6 of us that he hoped would be used to pay for our kids' education. And I think his mindset was that I want you to be free not to ever feel obligated to take a job that you don't like, or feel that you're one medical procedure away from really being desperate, and it can happen quick. Yeah. And so that surprised us all. In fact, we all got together like, wow, he really gave us the head fake.
What were your grandfather and father's philanthropic interests? Like, what were the things that they were passionate about giving the money away to?
My grandfather had very, very much a sort of a political orientation. You've got to think it was a time, in the 60s and 70s especially, he had always wanted to be in public service. His namesake, Shelby Cullom, nobody's ever heard of him. And yet 50 years, this man was a governor, a senator. He was a senator from Illinois. He died in 1917, but he'd been governor of Illinois and a freshman congressman under Lincoln. And it was sort of my grandfather's role model. Like that's who he wanted to be.
Buffett's dad too.
Yeah, but I will tell you, I read this man's autobiography. In fact, we were all sort of obliged to. And it's like, I don't know, however thick that is, 400 pages about the Interstate Commerce Commission and some problems with the Mormons in Hawaii. I mean, it was so boring. Like, you can't believe it. And on the last page, he says, I'm writing this as an old man from my apartment in Washington, D.C. I have outlived all of my children and both of my wives who were sisters.
That's different.
Successive, he wasn't married to them both at the same time. And so I'm leaving this book as my legacy.
He has
and I think
else to tell,
300 or 400 pages, and you talk about burying the lead. I had no idea. But so that had always been of interest to my grandfather. And so when he watched in his mind the country going to hell, why isn't Princeton teaching proper history? It's got all these communists in there. I mean, it was very sort of familiar idea, demonstrations in the street, people, things being burned and riots. So he was very involved in what I would call sort of conservative political organizations, and some like Hoover and that were behind sort of Reagan's election, the Heritage Foundation. So my father went in a completely different direction, and he sponsors and at a cost of millions and millions of dollars per year. I think he is the largest funder of higher education for kids that have this sort of international orientation. And so, it might be $20 or $30 million a year. So it's an enormous program that's called the World Scholars Fund. But
Josh and I were just talking about this week. There was a big article in the Times about the largest generational wealth transfer ever and how it might worsen inequality. But I was making the point that one of the silver linings of all of this money is there are real philanthropic efforts today that I know it sounds like your family has had in place, but that was not like global, or there was not necessarily a thing in the 60s.
Yeah, although it's funny. I lived in Europe for a long time. It is one of if you want to take enormous pride in being an American, you could start there. The culture of philanthropy, and I would say it was really started with Ben Franklin. You think of what Ben Franklin created in terms of philanthropic impact that rolled through, Pennsylvania,
the city,
the city and the state for 150 years, and continues to this day. But certainly Carnegie, John D. Rockefeller. I mean, these were enormous, the Mellon family, enormous fortunes that changed the world. And
that's why the names still live on, because the money still lives on.
Yeah. And there's no tradition of that anywhere else in the world.
Is that true?
It doesn't exist in Europe, in the UK, and Asia. I think it has to do with this view, this sort of I read a book about architecture in the Hudson Valley. It was a pretty obscure book. It was written in the 19th century. And it included blueprints for building a country house, because you had the middle class was being created then, and there was this idea of, wow, people in the city could afford to. And And these blueprints were these very modest homes that you could add on to over time. And in the beginning, he says, why not palaces? Why not? And he said, because our system of democracy will not allow for an aristocracy. And so what we want is the capital to continually be recycled, and that's what we expect. And he predicted, the author of this book predicted that the great mansions that were being built in Newport and would have to become educational institutions or religious institutions.
And so many have.
And they did.
Yeah.
He was right.
Or just torn down around here.
Or just torn down. And so that, I think it has to do with this, this anti-aristocracy view that was so sort of embedded in this history. You know,
we don't like it. We don't like aristocracy in this country, but we do like oligopoly. And there are some differences, but there's room for one.
Yeah.
I mean, how many people signed the Giving Pledge?
A lot.
I wanted to hear how the two of you hooked up, because you guys are like, I don't know
hope
what
you're not using hooked up in the
I was thinking
not the way my teenagers
Finance
use it.
Tinder.
How did you guys meet and hit it off?
I'll let Chris tell the story.
Okay. Yeah, this was amazing because I read this book when it first came out, and I really thought, like, if one of the most I think the highest praise you can give a book about finance is if it's useful. And I read it. I thought this is the most useful book on finance that I've really ever read in terms of the breadth of its appeal. Right? You think of like One Up on Wall Street, but to me, One Up on Wall Street was a little bit dangerous because it was telling everybody, hey, just find something at the mall that you like and buy the stock. And of course, The Intelligent Investor is just a masterpiece, but it somehow is not something that is going to cross over into the world of people that are not interested in investing. And I liked it so much that I actually bought copies for all of my children, my godchildren, my nieces, nephew, and I wrote them a letter where I said I would pay them a couple $100 to read this book. It was so useful. And I said all they have to do to collect the money is to write a one-sentence synopsis of each chapter. And this was before ChatGPT. But just in case they read the Cliff Notes, they also had to cut and paste their favorite sentence from that chapter.
Oh, okay.
So that was it. And I said, do that, you'll collect a couple $100. And I was saying to Morgan the other morning, I wish I could short the relatives that did not respond and go long the ones that did, because it was.
Well, you were saying you think a fund of CEOs who write a letter to their shareholders every year. That's a good screen.
It's a good sign
go the other way.
Yeah, it's a good sign of their sense of accountability. But anyway, so then I talked to our client team. I was like, we should send this to clients. We should order 20,000 copies, which we did. And then I said, and I'm going to reach out to Morgan. So I sort of cold emailed.
He had to sign all 20,000.
Morgan, I was like, get your pen out. You're going to have writer's cramp, like George Jetson finger at the end here.
Get your stamp out, more likely.
Yeah. And I said, I don't know if you know anything about our firm, but I just need to tell you how wonderful this is. And I got the most wonderful note back from Morgan saying, I actually saw that order and I was curious where it came from, and I was really.
I had known about Davis funds forever, particularly at the Motley Fool. Chris's grandfather is a legend. And he's a legend for anyone in the industry. But Tom Gardner of the Motley Fool just idolized your grandfather to no end. And he was Tom Gardner's favorite investor by far, that he learned the most from.
So I had been following. Why do you think that was?
It's a good question. I don't know. I mean, the results speak for themselves. I think there was a simplicity to what your grandfather and father and you do that really caught on to the Motley Fool, where it was talking to ordinary individual investors. So I had known about the Davis family forever. And then when I heard someone bought 20,000 copies, I thought, oh, that's neat. And it wasn't until a couple months later that I learned, it was Davis Group. And I thought, it can't be that Davis Group. And I learned it was. So that was cool.
So I wanted to start with something where, I was on TV today having like a little bit of a heated argument with two people who I really like a lot. And they call themselves value investors. And there's nothing, everybody has, I'm a GARP investor, I'm a growth investor.
GARP always kills me because it's growth at reasonable prices. You're like, what are the other guys?
Growth
at unreasonable prices.
Stop this going out.
Growth at an unreasonable price would be a great book title. So they're like, they call themselves value investors, and they really are, and they really have a discipline, and okay. And the argument was, I mean, it was stupid. It was with friends, but it was like, it's on TV, so everything's amped up. And it was basically like they're investing in things that are obviously not what's hot right now, and they should not be. And that's perfectly fine, like industrials and whatever. And meanwhile, you have this AI thing like crashing on us like a wave. And the dismissal of it was like, all right, so why are these stocks going up, or why are people buying them? And it was like, well, it's just behavioral. Like, they don't know what they're doing. They're just, and I just took that, like, and I'm not like chasing every AI stock up, but I own Alphabet and I'm buying it. And I don't think it's outrageous. It's at 22 times next year's earnings. I don't think I'm buying a bubble. Maybe I am.
Yeah.
So I just thought that dismissal, like, oh, it's over a 15 PE. It's a stupid investment. I'm paraphrasing. But I'm curious what somebody like yourself, when you see this, and you've seen it before, we've seen it with blockchain, wireless, 3D printing. Some of these turn out to be meaningful, some of them don't. What's your takeaway from a situation like this where the entire investing public becomes captivated by a new technology that seems to be emerging out of nowhere and just grabbing everyone's attention?
Well, Gates had a great comment where he said, new technologies tend to be overhyped in the short term and underestimated in the long term.
I love that.
And I think that's exactly right. I mean, it's funny. I'll say something about my grandfather in terms of a culture. When
big AI guy, I've read.
Well, in a funny way, he was a big hot growth guy.
Okay.
Because when this part's boring, which is he started life. He wanted to be in public service. He took work for Governor Dewey when Dewey was running against Truman, and he thought, I'm going to ride Dewey's coattails to D.C. I'm going to get a job in the State Department. It's going to be really cool. Dewey loses to Truman in that famous headline, and but he's still governor of New York. So my grandfather, who thought he would be, deputy secretary of state or something, is instead
Ranger,
deputy superintendent of insurance for the state of New York.
Oh, okay.
I mean, talk about a come down, right?
Yeah.
But the soldiers were coming back. The baby boom was underway. The suburbs are getting built. What's the hottest growth area? What's the first thing you do when you create a family in 1948?
House and car.
And insurance. You buy insurance.
Life insurance.
Because you need security for your family formation, life insurance. And the trouble with the way life insurance works is salesman sells you a policy, the salesman gets a commission. That commission might be higher than the revenue in the first year. But you're going to stay with that company for 30 years. So these companies were reporting losses, but they were creating huge value. So think of it as net subscriber growth.
Yeah.
Right? So he creates this idea of owner earnings, right? If I own the company as a regulator, I'm looking at these companies. Wall Street hates them because they look like they're just losing money. And he says, but they're creating value. So he resigns as deputy superintendent of insurance. He borrows $100,000, invests it entirely in insurance stocks. And it was like biotech. It was this enormous growth machine.
So on paper, they're losing money this year, but they're creating this revenue opportunity for decades.
They're getting a subscriber. They're getting a subscriber that's going to stay with them for 30 years.
It's an LTV calculation.
Absolutely. Okay. So that became part of sort of our culture. And he had all sorts of phrases for these, growth stocks in disguise. And it started, and it's honestly, a lot of our orientation over the years has been, he did it entirely in financial stocks. Over, I would say 95% of his portfolio was in financial stocks when he died, and had been for his whole career. And he found different ways to find growth in that industry. So you think about Geico, or you think about Tokyo Marine and Fire. So you had this growth in Japan starting in the 60s. He bought his first share in 1960 in Japan. And so he loved that lens of looking at an industry that was where the accounting sort of obfuscated and the perception.
Cable was like that.
Perfect example.
Yeah.
Cable was a perfect example. And the best example of my career is Amazon, right? Yeah. Amazon, this idea that we had this great example that we used to hold out for clients. We'd say, look, over the course of 17 years, Walmart grew from $1 billion to $70 billion in sales. That took 17 years. over 17 years, Amazon grew from $1 billion to $100 billion. So roughly that's the same. You know, it compounds to almost the same over 17 years. If you owned Walmart in that period, you would say, but yeah, Walmart earned a lot of money. Amazon didn't earn anything.
Yeah.
Look at the cash flow statement. If you owned Walmart for that entire period of time, sometime over that 17 years, you had to write a check for about, as I'm doing this from memory, but I want to say $8 billion. So you owned 100% of Walmart. You grew sales from $1 billion to $70 billion, and yet somehow, and you reported a lot of earnings, but when you went to your bank account, the balance was negative $8 billion. Now, why? Well, because they reported earnings, but they had to buy land and build stores and put in inventory. And so that's a capitalized expense, but it's a cash expense.
Yeah.
So when you looked at Amazon over 17 years, they went from $1 billion to $100 billion. Somehow in the bank, they had about $5 or $8 billion of net cash generated during that 17-year period. It was no earnings, but there was like a $10 or $15 billion difference.
Because the difference is building it in the 1960s and 70s versus building it in the 2000s.
Well, it was one was built by capital spending and one was built by investment through the income statement.
Yeah.
Which was essentially we are willing to lose money on each new policyholder, each new Prime member. We're going to give them free shipping, but we think the lifetime value of that subscriber is going to be much higher than the cost that we're paying.
So Chris, I think you're giving me license to just go crazy and buy AI stocks.
Well, I will say for every I used to say for every dollar Jeff made for Amazon shareholders, he's going to lose $20 for all the companies that wrapped themselves in the same flag, but actually had no lifetime value for that customer.
Let me read this quote. Hedge fund billionaire Steve Cohen reportedly urged investors not to miss the, quote, big wave of artificial intelligence and to stop fixating on a recession. The founder of Point72 Asset Management and owner of the Mets said at a private SALT conference event Tuesday that focusing too much on recession odds may lead investors to overlook AI investing opportunities. Acknowledge the types of jobs that AI would displace, but it'll create new jobs, et cetera, et cetera. Okay. He said, quote, I'm making a prognostication. We're going up. I'm actually pretty bullish. His take is that AI is going to be a wave of capital spending and cost savings for corporations all at the same time. Stanley Druckenmiller just loaded up on NVIDIA shares and made a new investment in Microsoft. Bill Ackman just bought $1 billion worth of Alphabet. So like
Michael Bannock just bought $10,000 worth of AMD and Micron.
That's right. So it's not just retail. It's like some of the most successful living, working investors are buying into this, or some would say kind of leading it. It makes it really hard to look at that and say everyone's going to lose money on this.
But this is a perfect tee up for the conversation that Morgan was having relative to his next book, which is what doesn't change.
That's right.
So the question is, AI is going to change everything. Well, of course it's not going to change everything. It's going to change a lot of things. And so the first question is, what isn't it going to change? And so are those things undervalued? The second is, what is it going to change favorably? And the third is, who's walking dead and they don't know it yet, right?
Yeah.
Like think of the newspapers in the early days of the internet. You know, you could have thrown a dart at internet companies and you were going to lose a lot of money. I mean, you had to get Amazon, but you would have lost money on a lot of others because all of the charlatans were in peddling the hot story.
That's right.
And of course, you had time in Amazon, right?
Yeah.
And by the way, you even had some time in Google. Not really. I mean, Google really came out and kept going up, but it came out in the ashes of that tech telecom meltdown. So, I mean, it was.
I think it benefited from it. I think Google IPO was 2004.
Yeah.
Yeah.
I think they did a Dutch.
It was a fabulous
offering or
system. Yeah, it was sort of a reverse auction.
Yeah.
And
in terms of predicting the winners, wasn't Google like the 15th search engine to come to the market or something like that?
Yeah, Ask Jeeves and
they were not the first. Not even close.
First mover is not always
I don't
important.
even think they were the first 10, honestly. Or they might have been, but it was not.
No, they weren't.
Yeah,
They
Yahoo,
definitely weren't.
Ask Jeeves. Those Yahoo was the obvious.
I remember Ask Jeeves. I remember using it.
Yeah. Excite. There was a bunch of them. Yeah.
So it's all right. So my prediction is we're going to have a full blown AI mania, And unless the Fed takes overnight rates to 8 or 9%, like,
And even
it's
still, you can have a
even
bubble
still-
even
with
still,
high rates.
and here's how early I think it is.
Rates higher in the late 90s than they are
They were like
now.
6% on
Yeah,
average.
Yeah.
It's so early that we haven't even had the IPOs yet.
I was just
That's,
there's no
that's what I think
companies.
there's no companies.
And that's
There's
part,
no AI
that's
companies
part
like
of why
selling.
these stocks are levitating is because there's so few
There's
of
no
them.
doing like the
supply.
picks and shovels of Nvidia and Microsoft right there. There's no supply, right? I feel like there's very few products where the first time you use it, it's obvious that you're experiencing magic.
is it-
and you've made, I think it was you who made this of like, ChatGPT is what Bitcoin wanted to be.
That's right.
And in Bitcoin, it's been 15 years of it's coming, it's coming, it's coming. It's going to change the world. It's coming
Yeah,
soon. Just
we're
wait, just
building.
wait, just
We're
wait.
building.
Whereas ChatGPT, the first time everybody used it, you're like, oh, that's it. This is
Yeah.
it. I can use this.
You're so
and
right.
I already know, I think 3 realtors who use it to write their descriptions of the homes that they're selling. There's
Yeah.
already, I think the closest thing with the internet was the first time that you used AIM, AOL Instant Messenger. The first time you use it, it's instant. You're like, I can see how this is going to change my life.
Everyone's first
today.
reaction to ChatGPT is, holy shit.
Everybody,
as a joke, I wrote a legal document with a command. Like I probably
Yeah.
wouldn't. I don't know if it would hold up in court, but just the idea
probably
that
good enough, though.
at this
Yeah, it's
stage,
probably better than the 25-year-old paralegal that's writing most of the stuff when
And
you're
then to
paying
think that this
you know,
is-
$300 an hour for the lawyer.
Is it morally wrong to invest on the premise that other people are going to come along way thirstier than you are and pay much higher valuations?
I'm a greater fool investor. That's my style.
And you know
think
it's gonna
that's a
happen?
I
That's
think
my
it's a
strategy.
It's bad,
idea.
right?
Isn't like a Soros thing? It's like whenever he sees a bubble, he rushes out
Wait,
to
hang
buy
on,
it.
Chris.
Yeah.
What if you get out before it crashes?
I know.
I'm only
It's
teasing.
but
It's bad, though.
it's reflexivity. The trouble is it works, but it's simultaneous that it works and that it's totally irrational. And so the question is, are you pragmatic enough to just do something that you know is irrational? And I'm such a regret minimizer that I was telling Morgan this morning the story of a guy that used to work for me and he was always looking for a system. And he got really frustrated because he said, Chris, if I had a blind monkey in my office pointing to the Wall Street Journal and picking a stock every day, and every single day that stock went up, day after day, week, month, year, 3 years, you still wouldn't put any money in that stock, even though it had worked every single day. And I said, of course not. It's a blind monkey.
The process.
And it drove
The
him
process is
crazy
bankrupt.
because he's like, you're
Yeah.
just not being pragmatic. So
we were also talking about, there's a thing from George Soros that he talked about. His most reliable market metric, George Soros, was his lower back would start hurting. And every time his lower back would hurt, there would be a market crash
his
coming.
son actually
His son talked
revealed
about
that.
how crazy
By the
it
way, I
was.
love that story. It's definitely make-believe.
It's a great story,
It's a great
though.
story, but that's bullshit.
You think so?
Yeah, I think it's totally make-believe.
All right,
I love it, though.
So I want to talk about the economy a little bit with you guys. And the question is, where is the crash? So I know it'll start as soon as this airs. But we got, myself included, we got really negative, just in general, the public. We got really negative while unemployment was sub 4%. Anyone that wants a job can have one right now. Pretty much in any region of the country, almost every industry. Maybe not newspapers or commercial real estate, but like generally speaking, there's a job if you want it. This week, we heard retail sales turned positive and home builder sentiment turned positive. This is not what a recession is supposed to look like. Let me give you the data, and then I want to hear what you guys think. Americans boosted their retail spending in April for the first time in 3 months. A sign of consumers' continued resilience, blah, 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 blah. Rose a seasonally adjusted 0.4% last month from the month before, after declining in February and March. So that's one. Do we have this chart, John? This is U.S. retail and food services sales change from the prior month. Like, just one example. Aren't we supposed to be, like, breaking new lows in this blue line by now?
Why are we supposed to do that?
We spent more on autos and dining last month because the Fed has raised interest rates 500 basis points and everyone predicted recession.
But that's it.
Everyone
knows how impossible it is to predict the economy, but then they get flabbergasted when they can't do it.
Well,
Here's builder real quick. Builder confidence. This is like home builders responding to a survey, so whatever. Take it with a grain of salt. Builder confidence in the market for newly built single-family homes rose 5 points to 50 in May. It's the 5th straight month of gains and the first reading of builder sentiment since July that wasn't negative. Of the index's 3 components, current sales conditions rose 5 points to 56. Sales in the next 6 months rose 7 points. Buyer traffic rose 2 points. Again, with what the Fed has already done, I don't think we were looking for these numbers to start to reaccelerate to the upside. But maybe what do I know? I'm curious what you guys thought about this.
I'm not a forecaster. I don't follow the economy, but
all right, next.
What
do you got?
but this is example number 10,000 of people can't predict what the economy is going to do. How many times we got to learn about it?
You got that right.
But everyone's still surprised when they can't do it.
But historically, when the Fed wanted to slow the economy, they raised rates and they were generally successful, right? So
I'd take the other side. I think we've had I probably invested through maybe 3 big bubbles. So, commercial real estate at the start of my career, the S&L crisis.
Was 89, 90?
Yeah, looked through office buildings, looked through apartment buildings, and recession out of that. Then the tech telecom and the financial.
What does look through mean? Empty buildings?
Yeah, empty buildings.
Okay.
Nobody's there. They're just hollowed out. And then, and then of course tech telecom, and then the residential real estate and the financial crisis. The bubble that we have gone through in the last 10 years, there's no parallel in history for the scale of the bubble. I think, if I'm doing this from memory, but I think in 2 years, there was $30 trillion of debt issued at almost a zero rate. So there are huge losses out there, but that's not even the most important part. The most important part was people invested based on the idea that money was free. In 3,000 years of history, money has never been free.
Yeah.
Right? It doesn't make any sense. I have some money.
Quite an experiment we ran.
It's an unbelievable experiment. So they printed all this money, but they artificially stopped the inflation and the devaluation that would have happened by buying up all the stuff that they were printing. So it may be puritanical, but I just can't believe that the popping of that bubble was, 3 little banks, who had some problems.
That can't be it,
a little
right?
bit of trouble in VC land, some markdown on private equity, and we're just going to coast on through this. I think the ramifications are going to come out. And by the way, I don't think owning good businesses is a bad idea given the uncertainty of the world. So but I think the idea that it's a time where you should be thinking about speculation in terms of, we'll take a flyer on a few future earnings. And I think that the unwinding of this bubble will have, and I think we may look back and say we're actually already in a recession. It's rolling in a very unconventional way because leases are rolling over slowly. Private equity firms are going bankrupt slowly. People are getting no bid on businesses.
But as a stock market investor, though, how do you counter the argument? We're going to go here next anyway. How do you counter the argument of what earnings are doing? These companies have been incredible. We were supposed to have negative 7% earnings this quarter. We have all the numbers. It's -2.
There was a great quote from Bank of America, something along the lines of never underestimate an American's company ability to retain their profit margins.
Yeah. Well, I think companies, this is why I like owning companies versus
owning
a lot of other things.
Yeah.
Because companies are able to adapt. Companies have real resilience. But I just think that the party that went on in the last 10 years was so extreme. And I think that, consumers have gotten used to very low debt. They aren't really adjusting their lifestyle thinking about these higher, real estate is not really transacting. So there's a huge spread widening.
They froze the market. They don't have marks.
A lot is frozen.
Yeah.
And I think there's this sense. Did you ever read the book On the Beach by Neville Shute? Yeah. Oh, it was the most nightmare of my childhood. But it was about a big nuclear war in the Northern Hemisphere.
Oh, I saw the movie they based.
Yeah, it's set in Australia. And they know that the cloud is coming and humanity is going to go extinct. But it's sort of their last year and they're partying and and there's this, it's just trying to describe the effects of knowing that this cloud is coming and not being able to do anything about it.
I wrote this last night at 9:05 in my computer, thinking about the state of the American investor and just us and everyone. So I wrote, how can the worst be over? Referring to the stock market. How can the worst be over when the worst is yet to come? And I think everybody sort of feels that way, that things are going to get bad. And how is it possible that the stock market front ran it to the extent that it did, where it bottomed back in October, the NASDAQ was only down 35, the S&P was only down 25. How could that be it?
Well, I again, I don't think the market's the market, right? The narrowness. What you're seeing is a lot of the average companies have been struggling for some years, right? So you've seen this narrower group. That narrower group employs relatively few people. So going back to the Henry Ford sort of idea, if we don't, and what has kept people up is refinancing. It's like, well,
and that's over now.
And that's going to push the other way for some time. So, I mean, I own a lot of banks, and people say, well, given you're sort of negative, how can you own banks? And my feeling is because they're prepared. They are literally prepared to go through another financial crisis. Like
most of them.
Well, not to like get too into the weeds about this stuff, but people are worried about higher financing costs. But like 90% of the debt of the S&P 500 is fixed long term.
So at the household level, it's probably even more. Everyone's got a 30-year mortgage.
So,
and now you're locked into your house. Eventually, you might have to move. But household debt payments as a percentage of income is the lowest in 40 years.
Yeah.
And it's way lower than it was 10 or 15 years ago. Like, there's a lot that can go wrong and not come close to breaking a precedent.
But every one of those homeowners that's feeling good about having locked in, or every corporation, somebody is on the other side. And by the way, it's mostly not a bank. It's mostly
somebody lent them the
pension
money.
plans,
shadow banks.
Yeah, it's all the shadow banks, and it's so. I, my grandfather always said, "You always sound smarter if you're bearish." Mm-hmm. So, and
he's still right.
And he was 100% invested or 150% invested his whole career.
Is that the trick? Say I'm cautious, but be 100% invested.
Yes.
Then you win, right?
Yeah.
I've been doing that for 10 years. I didn't think anybody else caught on.
You sound a little dumb or naive to be optimistic when the world is terrified. But I think in this case, my view is, we want to own businesses that are resilient, that can get through. I don't want to own bonds. I don't want to own, because I have no idea. Like, there's a lot of, I want to have some international diversification. I want to have businesses that have gone through all different types of cycles, because I don't want to optimize to some economic view. But I think that, when we look through at individual companies, we're seeing a fairly steep decline beginning to roll through. And I just think there's been a little bit of that on the beach, sort of the summer before the war.
Like we all know that there is debt that has to be rolled, that cannot be rolled at prevailing rates. We know it 100% for a fact.
And so commercial real estate stocks are down 80%.
Yeah. But
the market knows too.
But the cost of capital is everywhere. It's not just debt. It's PEs. It's what it was what people were willing to pay for earnings 10 years from now. It's I look at some of the consumer stocks at 22, 25 times earnings.
Pepsi, a lot of these staples.
And I just think, boy, that looks very, very risky.
Oh no, they're safe. They're staples.
Yeah, they're safe.
Let's. I want to do these charts, Mike. The S&P net profit margins.
So I put these charts in the doc prior to James Montier writing a mea culpa this week. So the big thing about that GMO's bear case was profit margins being a mean reverting series.
I know.
And that just hasn't happened. And I think one of the reasons, so we're looking at a chart of profit margins, excluding financials, going back to the 70s. And basically for the good part of the last...
Are they 12 or 13?
For the last 20 years, it's basically been up and to the right. And this isn't rocket science. This is...
It's the internet.
This is Amazon. Right. This is Apple. This is Microsoft. So these are companies that deserve to trade at a premium, that have always and will... No, I don't want to say will always.
And in the 70s, it was all railroads.
Right.
Copper smelting. Right.
Hey, copper looks pretty good.
But is this a story of more efficient corporations, or is it a story of the makeup of the S&P 500?
Well,
or both.
I'll also, to tie it back to AI, you think about what globalization did to the U.S. worker, and of course the massive adjustment that came as basically all of this sort of middle class was sort of put out of work, and they went one of two ways. They either became what was Microsoft called knowledge workers,
right. or meth. It's bad.
It was bad.
It's bad,
and
we're still feeling the repercussion of that displacement.
And I think AI is going to do the same thing to a lot of white-collar jobs. Yeah. Like, I have a son who's a lawyer. I was just interviewing some kids, I won't say the college, and I said, okay, just between us in this room, how many of you are submitting work written by ChatGPT now? substantially written by it.
That's how I got through Trump University.
Yeah, it was like 80.
I never would have graduated.
It was like 80%. And by the way, they run another program after it to insert errors so that their teachers won't catch them. So, put double spaces and add apostrophes. And but I can tell you all of those, you think about what it was to be, work on a machine line. Well, the functional equivalent of that is all through the knowledge worker universe. They're copywriters, they're editors, they're paralegals, they're lawyers. It is. So I think
it's the new assembly line.
It's what happened to the blue collar is and in fact the irony of it is I think the plumbers are in pretty good shape, and that's where you're seeing great wage expansion, and by the way, overdue wage expansion. Minimum wage went from $8 to basically $18.
Can't find
in about 3 years. You can't find them.
Can't find truck drivers.
Yeah.
Right.
Our friend down in Richmond, we were listening to a country song that was called "I Need." I need the work less than you need the work done, and so it's like, don't piss me off. And of course,
but isn't that like that irony delicious? You've got this class of people who spent the last 10 years flying around to Davos, sitting on stages and saying all these blue collar people are, these poor people. Meanwhile, who's laying off? It's Netflix, it's Amazon, it's all knowledge workers being laid off.
Yeah.
We don't have any blue collar people being laid off.
Law firms are in front of, I think, a massive wave of layoffs. I don't know about accounting and some other, but these are big earning professions. They're the backbone of the suburbs. They're and so think about what happened to Hartford when the insurance industry sort of got hollowed out. I mean, Hartford.
Connecticut.
Hartford, Connecticut. I mean, Hartford, Connecticut was an incredibly wealthy town.
My understanding was it sits up high, and the reason it became an insurance town was because if you insured a ship coming from Europe, you could literally stand up at the cliff and see your ship come in.
Well, I don't know about
that. That's how you knew you were okay.
What I know is that they employed tens of thousands of people in these huge buildings, and basically a lot of them were clerks typing out policies, calculating. All of that got computerized, and Hartford was hollowed out. And so I just think that the ramifications of all of these things, to me, don't point to a rosy 10 or 20 years for the U.S. consumer. Yeah. And
you are trying to sound smart, aren't you?
I am. I know.
No, but it's good.
I'm still. Ask me how much cash I have. The answer is like 3%.
It's good for profit because it's good for what you're describing is unfortunately very good for profit. Might be bad for society, but it's pretty darn good for what's the next one that we have?
No, but I think this is rational. I'm always afraid, but I'm always fully invested.
Yeah.
Okay, so the next chart is just, so I think that up and to the right nature of profit margins tells a lot of the story about why stocks have done what they've done despite high valuations. Yeah. So this was from Monte. We don't need to get too much into this, but that's when he wrote the post about how profit margins need to mean revert.
The line.
The line, I'm sorry.
What is that, 2013?
So it's 2013, and it's a
ago.
decade later, and they haven't mean reverted, and who knows if they will. But profit margins have come down over the last several quarters until most recently, the first quarter. Next chart, please, John. It's too early to say whether or not that was the bottom, but
this is not supposed to be happening with the cost of capital having done what it's done.
They should be deteriorating, and maybe they will.
Well, think of the components of profit margin, right? So you've got, your cost of goods sold, you've got labor, you've got taxes, you've got interest. It's hard for me to think any of those things aren't going up a lot and won't squeeze that. And by the way, that is even true for a lot of the tech companies. They had and so I think you can find that sort of that needle in the haystack. I think it's what we only own 40 stocks out of the thousands that are out there because our general view is there's not that many businesses that can be resilient in a tumultuous world. And if we don't get a tumultuous world, we're fine. But if we do, I think there's a lot of hopes and dreams that can get revalued fast if that's all you got on the books is a fantasy or not a fantasy, a dream, a vision about where this business could be in 10 years. But, again, that can change fast.
But isn't the other side of that is that revenue's going up by just as much? Like that was
that's where I wanted to go next. I'm glad you brought that up.
But nominal revenues are at all-time highs too, I think.
This is the rundown of this earnings season. Through Friday, we have 92% of the S&P companies have reported earnings. This is from Sean. 78% saw a positive earnings surprise, but 75% saw a positive revenue surprise. The earnings decline for Q1 in the books is negative 2.5%. 6.7% was the estimation. So we were way more bearish than the reality. The forward 12-month PE ratio for the S&P is now 18. The 5-year average is 18.6. The 10-year average is 17.3. So we're at an average forward PE. You've got 78% of companies beating on earnings.
But so this is the thing. So obviously, Chris, you are owning businesses and you think about investing in through that lens. Morgan, you've spoken about this a million times. It's just different. It's a mishmash of a million different objectives, goals, timeframes, all that sort of stuff. So to Josh's point about us beating low expectations, I know you don't give a shit about this in the short term, but I do. At least it's interesting. The S&P 500 is breaking out today to the highest level it's been since August 2022. Interest rates are breaking out of their range to the upside. You've got the debt ceiling looming. Everybody is positioned not for the upside.
Yeah.
And so that's how you get just people off sides. And again, this corrects itself over time, but in the short term, it could lead to some outrageous behavior.
Yeah. Does anyone care about the debt ceiling too? Outside of
We'll care for one day when there's a technical default, and then the outcry will be such that they'll figure out a Band-Aid to slap over it.
Yeah.
Nobody will really give an inch.
Right.
And we'll have another debt ceiling fight in a year or 2 years.
Or less than that, yeah.
Yeah.
But I think if you think about it feeling like sort of a fragile world, I think that what we're forgetting is the nature of surprises, right? So, nobody predicted Ukraine, nobody predicted COVID,
Right.
nobody. These things can happen, and I just think the sentiment right now is nervous, but kind of holding. Everything seems to be okay, and what we haven't seen is sort of a panic. We saw panic in the banks. Like the banks
I wanted to ask you about that. So SVB and Signature Bank, former executives, were in Congress this week. And this looks pretty bad. Execs of Silicon Valley Bank are being grilled for the bank's failure. Many sold before the collapse on March. They sold their own stock.
But hang on, I think a lot of this, I don't know if all of it, but a lot of this was pre-scheduled sales.
Yeah.
So what?
Nevertheless.
So what? You think people understand that?
good.
No,
But I don't
nevertheless, the fact that I think there was shares sold the day before they went under.
Yeah.
Gregory
So
Becker-
just optically, that's
Okay.
not good.
Put this chart up, John. Oh no, we don't have this chart. This doesn't matter. All right. Gregory Becker, is a CEO of SVB. Sold 11% of his stake on February 27th, 2023.
That's a lot.
Daniel Beck, the CFO, sold 32% of his stake on
That
February
doesn't sound pre-scheduled.
27th.
That's a lot.
Michelle Draper, the chief marketing officer, sold 25% of her stake in February. And by March 10th, it was gone. Like, that's problematic.
Yeah, that's pretty bad.
That's bad.
Yeah.
But I guess, we could spend a little time on these because, talk about something that was completely predictable. It wasn't predictable that they would collapse and there would be a bank run, but it was predictable that they had taken enormous risk. We wrote a memo to our board in November sort of showcasing, it happened to be First Republic, but just saying these three banks have outperformed our financial holdings by a lot, like 500 basis
And
points
here's how
a
they
year.
did it.
and we think they're taking crazy risk.
Yeah.
And so that's why we don't own them. And so, but I think the bigger question is, why the hell did companies like Capital One go down 50%? Or, why did the rest of the banks? And that's what I mean about you don't know what the trigger will be that could cause a massive revaluation downward because people panic. It made no sense.
Are we gonna have regional banks in 10 years?
Well, yes. We
Will they
have
trade
to.
at 3
'Cause
times?
look,
Will they
if
trade
you're-
at 3 times
If you're going
earnings?
to build a strip center in Waterville, Maine, the idea that you're going to go to J.P. Morgan to finance that, it just doesn't make sense. You've got a local banker that knows you, and you're going to go to Bar Harbor Bank and Trust or Portland or something like that, or Camden. And so I think that function is really important. I think the relationship of deposits, and we'll see. But what I will say is that
Well,
the top
there's 4,000 of them. Do we need 4,000 of them?
Well, there used to be more, and every year the share of the top 10 has grown. Every year of my career.
And it's a standout too. You go to Canada or the UK
Yeah.
and there's like 5 banks in the whole country.
Yeah, they don't have that.
Yeah. But in Germany, you have, you had a handful of big banks, and then you had these like middle market banks that served local regions and were sort of mutual. So I think it will continue. in just that path of consolidation. I think the big banks have better accounting. They have more capital. They have deposit inflows. They have a technology scale advantage, which really matters. They have more
Have you
diversification.
noticed the change in rhetoric about the big banks? 15 years ago, the problem was they were too complex.
Fat cats.
Yeah.
Well, no, they were like the complexity.
Yeah.
Now we don't say complexity. We say, look how sophisticated they are. They could absorb an ailing bank in one day.
I know.
Like,
The
no
thing
questions asked.
that upsets me the most, and we'll see how it plays out, or worries me the most, is that I would say the big banks, since the financial crisis, have comported themselves fabulously, right? COVID, they were out putting credit out. We're working with you.
I completely agree.
And we're going in this crisis. They're like, hey, we didn't take any of this crazy interest rate risk. Jamie Dimon used to stand up at conferences as recently as the fall and say, you guys want another $1.5 billion of earnings. I can make a phone call and put it on now. I'm not going to do it because it's stupid. And so I thought we'll go, it was obvious that there was risk in the system and that these guys will be rewarded. And instead, there's this sort of outrage we're sick of all the banks. And so I don't quite know how to handicap. I do think that in the 1950s, banks, had gone through the crash, the Depression, World War II. By the 1950s, you ever see It's a Wonderful Life?
Yeah,
Okay.
of course.
So, if you're an investor, the hero of that movie was Mr. Potter.
Yeah.
Right? He ran a good bank.
That's
He
right.
he managed his liquidity. He was opportunistic, when
Yeah.
the idiot brother-in-law is losing the check. And, we liked George Bailey, but that captured the zeitgeist of the 50s, that, the big bank was reliable, boring, not risk averse.
Yeah.
And so what happened? Banks traded at 15 times earnings, a market multiple. That's how long it took to get over the crash and the Depression. And so our thesis on banks is, look, we went through the crash. We went through the financial crisis. We went through a massive wave of re-regulation. Then we went through COVID. Now we're going through but sooner or later, people are going to decide, these banks are boring. They're trading at 9 times earnings. The utilities index is at 22 times earnings. And by the way,
You
the
think they get
utilities
a
are paying
re-rating
out
for being boring?
for being boring.
Yeah.
And very boring, reliable
there's-
sources of growing dividends.
Do you think there's 5 more SVBs and First Republics, or we've seen it?
I think
it
that
would
would
have happened.
massively change FDIC insurance if you get 1 or 2 more
Yeah.
But I
instantly.
think
Well, there is no such thing anymore.
What do you mean?
Is FDIC insurance it's
But if they make it explicit, everyone's covered.
well,
Or come up with some other
they will
scheme.
have to though.
Yeah.
But would that stop a bank run?
Everybody, what did-
I actually do think I remember seeing that in Washington Mutual in 2008, that the majority of the deposits that were pulled were FDIC insured. Like you
Yeah.
can still get a panic even among insured deposits.
you can.
I feel like if there was another shoe to drop with the regionals, hopefully this doesn't age poorly, but it probably would have dropped by now.
Yeah.
I was looking at a schedule.
But I thought that too with First Republic. Like it had its collapse and then it just kind of meandered for
That's
2
true. That's
months
true.
and then it went out of business.
Well,
Like,
yeah.
what was going
but
on in
they-
those 2 months?
They had.
But the customer base.
Silent bank run in
Yeah,
those.
It was still going
silent.
on.
It
Yeah.
was still going.
Uh,
But
John-
it usually doesn't happen. It's usually thriving on Thursday and dead Friday. You
John,
usually
can we-
don't have a 2 month.
Can we throw this up? So I was looking at on TD Ameritrade at the cash sweep vehicle interest rates, and from a dollar range of $0 to 5,000 all the way to up to $1 million, and they have all these different tiers of what they're paying you on the cash, and it doesn't change. It's 35 basis points
No matter
across the
how
board.
much-
It's
no
like you
matter
could
how much
deposit,
money.
you could have $3 million in cash, and guess what, buddy? 35 basis points. What is this? Are the banks being greedy?
What
Do they know
what
human
is
nature?
this?
It's inertia. People just aren't moving. Like, yeah, people are going to move. They're going to move, but
Well,
not everybody's going to move.
I think the argument for us at First Republic, and I wouldn't talk about it if it was still trading, because I don't think you need to be throwing
When you
gasoline.
say for
on
us,
the
were you
fire.
on the board?
No. For us as investors
Oh,
in
okay.
banks, but not in First Republic. So what we sort of said is if we had a bank together that we created and we took 5-year deposits in CDs, 5-year CD, and we put it in 5-year treasuries, according to all this hype Twitter feed on the internet, we're bankrupt. We have no equity. We put up $10 of equity, $90 of deposits. Now the deposit, and we put it all into 5-year treasuries. The treasuries are down. That wipes out our equity. That bank is totally reliable, secure. You don't have to worry. But so the only thing that matters is if your assets and liabilities are mismatched. And so at a bank, you use TD. I'll use First Republic. there was a presumption that people with $2 million, $3 million deposits don't give a damn about earning 35 basis points when they could be earning 4.5. And we thought that is a strange hypothesis that's never been tested. Like, we would assume I would move, you would move, we would all move. So there was this idea of the lazy affluent.
Well, they don't move for 1%, but they'll move for 5%.
But if you go to Wells Fargo or something and you say, look, I've got, $700 in a checking account earning 30 basis points, am I going to really move that into a money market? And of course not. So you start thinking what really matters is the combination of how big is the spread and how likely is the customer going to move a small amount versus a large amount, so that sort of core funding, and how quickly do your assets roll over so that you can move up that march up that curve. If your assets are all locked in on 10-year mortgages, you're screwed because you thought that 10-year mortgage was going to refinance in 7 years. You know what? It ain't. A person's going to die with that mortgage. And but on the other hand, Capital One, Capital One pays higher interest rates. It's all the old TD. What was it called?
It was ING Direct.
ING Direct.
Yeah.
So they get a lot of their deposits online. They pay higher interest rates. They have a longer dated asset book, but they're roughly matched. Like basically the life of the deposits equals. So we'll say, okay, we'll pay you $350. Bank of New York, 100% of their deposits are super interest rate sensitive. So all of their assets are deposits at the Fed. So there's not a one size fits all. What I hate about this sort of Twitter panic is this idea, mark to market, they have no equity. Well, mark the liabilities, mark the deposits to market. And if it's Bank of New York, right, you're right. Those are one-day deposits.
The only asset they actually have is the confidence of their depositors.
But so the selling
and the service is that they, the deposit. You're right. It's confidence, but it's also convenience.
What do you think about calls to ban short selling, specifically in financial stocks, because of that confidence factor? Meaning,
they did the same thing in 2008, and stocks still fell 90%.
But if I spread a bullshit rumor about Intel or Pepsi, like the stock might fall, but I probably can't bankrupt, no matter how influential I am. Elon Musk probably couldn't bankrupt Pepsi with a series of tweets about.
Well, and it's credit default swaps. It's
a
lot.
You can do that though with a financial institution. You can bankrupt if enough people believe what you're saying and repeat it. So from that standpoint, I feel as though financials maybe could be set aside.
I also feel like SVB was so interesting because virtually every deposit holder is from the same social
also
group.
A Twitter asshole.
But they all live in the same neighborhood.
It's actually amazing.
I don't think you could do that with Wells Fargo because everyone's in a different social group. If one person yells fire, like no one else is listening to it.
So I think what happened with a lot of the banks that had nothing to do with this, Capital One, for example, was a rational overreaction. If you're a shareholder, it kind of made sense to panic a little bit. I'm not saying that was the right behavior, but it was. How about this? It was understandable why some people sold companies that they probably shouldn't have.
Or panic.
Well, I would
be the
say,
first to, if you're going to panic, be the first to
I
panic.
think there were calm, rational people who pulled their money out of SVB, their deposits out of SVB. If you see other people panicking and the bank relies on their feeling about it, like it makes sense for you to panic.
Totally. That is totally.
But you mean with the stocks? And,
I'm talking about stocks.
And I would say the wild card. You should say no. You're crazy to panic out if deposits are pouring into your institution. Your institution is becoming more valuable, and this is the classic example of when people are panicking. This is a classic value investor's dream. The business is getting more valuable. But there is a wild card in banking that's not just the confidence thing. It's also that how will the regulators respond? Because the regulators can't punish the dead banks, right? So they've got to go to the live ones. And so you think about after the financial crisis, J.P. Morgan behaved very well. Wells Fargo had behaved very well. And yet they paid enormous fines. They paid enormous, they had.
Right. J.P. Morgan paid the Bear Stearns lawsuits.
Exactly.
Because there was no Bear Stearns.
Nuwamu, Wachovia, all of those got paid by the companies that had behaved well. And so I think the rational reason that some people sold bank stocks in this crisis was not any concern that the banks were financially vulnerable. It's that they were regulatorily vulnerable. That the regulators could come and say, you know what, why you guys are getting all these deposit inflows? You're dancing on the corpses of these beautiful local community banks. How dare you? We're going to, insist that the government takes 30% of your equity. Or,
senators and Congress people love community banks.
Yeah. So here's the opposite. This is First Citizens, which bought SVB.
Yeah.
And that's a regional.
Vertical.
Yeah.
And that's a regional, by the way.
Yeah.
Was there something explicit, do you think, in the FDIC making sure that the first rescue wasn't J.P. Morgan? The SVB rescue was like a Midwestern.
It had to be.
Well,
It had to
First
be.
Citizens, is it New England or
forget.
Don't you think optically it couldn't be JP Morgan?
it couldn't be, right?
No, I think one of the hard things about the banks is it's a little like China, that somehow both Republicans and Democrats feel comfortable bashing it. Usually they split, but here it's sort of the Republicans are saying, oh, we don't like these elitist
Wall Street
institutions,
banks.
Wall Street banks, and the Democrats are saying, oh, we love our little community bank, and so that creates a vulnerability that I think is at real. I think it's worth investing through because you're getting paid for it with the enormous discount that they trade at, and with the idea that for a lot of these banks, this interest rate environment means their earnings are going up. Their deposits are flowing in. So their market share is growing. They have relatively little credit risk because all of that commercial real estate was regulated out of their portfolios after the financial crisis. So I think they'll be beneficiaries through this. But
I wanted to ask you about something. I don't know if it's philanthropic, but maybe it's just like a societal organization question. Connecticut just passed this thing for baby bonds. Every financial blogger who writes about behavioral finance would agree this is probably good. The big debate is more like how you fund it. Here's what Connecticut wants to do. Set up a $3,200 trust for every eligible baby born after July 1st. To be eligible, the household income you're born into is less than $65,000. Okay? They think it'll cost $600 million over the first dozen years, and then another $165 million in interest payments. So
how's the trust funded? Is there cash going in, or
that's
it's just
the debate.
another IOU?
The debate is not should we do this, because Connecticut has some of the worst disparity between rich and poor, and they know they have to do something. The debate is like, what are we funding this out
But by
of?
the way, also, this is not really that important, but it was sort of unclear as to whether this money goes to everyone. Because here's
And
a
then they
quote.
can cash out at 18, you said?
It's going to be used for when they turn 18. They could either go to college or start a business or buy a house in the state of Connecticut.
Yeah.
But it said Connecticut Baby Bonds has the potential to transform the future of our state by providing opportunity and economic resources to the next generation of young Connecticut residents, regardless of the financial circumstances of their families. So I think
That's the point. You talk about being born on third base. I was born into the middle class. Like, the idea is not equality for everyone. It's equality of opportunity. Yeah. It shouldn't count that much against you if your parents struggled in there. So I think everybody, Republican or Democrat, agrees to that concept that the world would be a better place if there were more opportunity and we didn't have people born literally with no shot.
Yeah.
The question is how you fund it. The Treasurer's Office estimates by investing the money, the accounts will grow to $11,000 or as much as $24,000, depending on when the recipients access them. An estimated 15,000 babies born each year are eligible. So the question is, for a state like Connecticut, for $600 million, if you're the politician that says yes to this right now, you don't benefit politically because this money won't be spent for 2 decades and you'll be out of office.
Yeah.
Can a state politician think that long in advance and get behind something like this? And if they do, is it worth the $600 million?
Oh, God, it would be so glorious. But the but that I'm saying is that cash, there needs to be cash that goes into an account. It can't be an IOU, right? And this is what the superannuation schemes like Australia, Norway, that's what they've done. Norway has $260,000 or something for every man, woman, and child invested in global stocks.
It's the oil wealth.
Yeah.
Right.
They bought Bitcoin.
Australia says we're going to hold back, 6% or 7% of your paycheck, just like we do here for Social Security, except they hold that back in cash and they give you a certain amount of control over it, like a 401k plan. You have to put it in, various approved funds, but you can choose. If Connecticut is really talking about funding an actual trust versus another IOU where it's just debt, then I would say it's a fabulous
funding.
And it's not a trust. It's like for the person. It's like you have it. You can count on it as a parent that's coming to the baby.
I think I love the idea. I think a lot of people would, but in terms of funding it politically, that might be tough because the money's got to come from somewhere.
Yeah.
This will get done though if they say, "Oh, and BlackRock is going to do the investing." Like they'll find a way to get it.
But isn't it kind of like the creation of the land bank? The land grant universities. I mean, think of what the UVA has done for the state of Virginia.
Yeah.
I mean, our friend Tom Gaynor went there to go to college and never left and has helped create enormous wealth for the state of Virginia. So that provided opportunity both for students that lived in Virginia, but it also became a recruiting tool to bring families, talented people from out of state who fell in love with Virginia. So,
Can we do one more? WeWork. This should have been killed in the crib, and it almost was. They tried to go public. $40 billion, I think, was the valuation being discussed.
They're shooting for 100.
Sure, why not?
100 billion.
This is, by the way, here's what's interesting.
If not for the S1, it would have happened, I think.
This is January 2019.
Right. Yeah.
January 2019, $47 billion valuation is what SoftBank paid in January.
But Lindsay made the point. That should have been the top.
It was the beginning.
Yeah.
It should have been the end.
And it was the beginning.
Anyway.
But you could say that about like the Netscape IPO in 94 or whatever, that should, but
this crashed.
And Netscape got a happy ending. AOL bought it.
The WeWork debacle could have, in an alternate universe, been the top.
All right. So anyway, they did it as a SPAC. They said, oh, all right, no IPO, no problem. We'll do the SPAC. This week, it had a really bad week. It dropped 25%. The CEO's leaving. I don't know. Everyone's leaving that was connected to it. John, do we have this chart? This is WeWork as a SPAC. You could see it comes out December 2021. Of course it did.
Well, that was the top.
It was worth $8 billion or $9 billion at the top. Now $500 million and
I think they've
falling.
raised $15 billion or something, right?
Somebody says the worst startup.
97% loss.
It's the worst investment of all time for a startup. I think SoftBank lost $12 billion.
Let me read this. They burned $5.6 billion between 2020 and 2022. They burned $343 million in the first quarter of this year alone. Their burn is going up, not down. And when they came public, they said they would generate profits, adjusted EBITDA of $500 million in 2022.
It was community adjusted EBITDA.
They actually lost $500 million instead. But they still did $3.2 billion in revenue. The problem is they just lost money on every dollar of that.
We were talking about Peter Lynch earlier and why the book was dangerous.
SoftBank lost $12 billion, and the Journal said it's the worst investment of all time, the worst startup investment of all time.
About Peter Lynch being like, buy what you know. If it's a good product, it'll make a good business.
I bought Peloton.
And I think the hallmark of the tech bubble was a lot of really great products invented.
Yeah.
And almost no great businesses came out of it. Yeah. So WeWork is an amazing product. If you use it, it's amazing.
Phenomenal.
Peloton, amazing product.
If you're all
terrible
businesses
if you're using the product.
Yes. And that's zero interest rates.
And that's why the Peter Lynch assumption, which may have been true in the 80s when he wrote this book, that every great product was going to turn into a great business.
Well, you know why? Because those businesses were not funded with infinity losses.
Right. So I think in that era it was right. But that's
he also says that he's being taken out of context by the buy what you know.
Yeah.
Nowhere in his books does he say
buy what you know.
Like
no,
whatever's in your refrigerator.
The story
just buy
in the book was like his wife going to a grocery store and
like
pointing out a product, and then he did research.
Right.
It wasn't just blindly.
It wasn't blind what you know. Fair, but that's what it's been turned into. But I think the WeWork is a perfect example of the difference between a great product and a great business. And there are so many of them that came out. There were so many great products.
Are you hiring any PMs from SoftBank?
It should be but
I will say something even worse about WeWork is that it's not just that WeWork was a bad business and destroyed it. WeWork made good businesses bad because if you owned an office building, you're like, oh, Jesus, we got to put in free or we're going to lose our tenants. And so it was the free capital that WeWork got destroyed businesses that were absolutely bulletproof for years because like, well, how are we going to compete with that? We've got to start discounting.
I'm so glad you said that.
Such a good point.
I think Robinhood destroyed the brokerage business.
And Netflix destroyed Disney.
Yeah. And now Robinhood's an $8 stock, but Charles Schwab is a $50 stock.
Yeah.
And it's almost unprofitable to do brokerage business now. I guess the consumers
why
won.
they had to turn into a bank or chose to turn into a bank.
I guess the consumers win, but like nobody feels like they're winning.
Yeah.
So that's the problem Who did we had Bernstein ask the question.
Which
what
Bernstein?
William Bernstein asked the question. We had dinner. We had dinner at a steakhouse. And we had like Zweig and William Bernstein and
Housel.
you were there.
Yeah.
That's when I told you how to promote your first book. Did you listen?
I don't remember you saying
No, it didn't work.
I guess you didn't want an
Only-
eminence, apparently.
No. You said, I'm not sure I'm going to promote it. I said, leak a sex tape. You remember? Did you do it?
Next book.
Okay. All right. So
Now that you say that, I do remember
he did
that.
say that.
He did say that. Bernstein loved that. No, Bernstein said, what happens to society if there's no cost of capital ever again?
I forgot about that.
Yeah.
He did
And
say that,
thank
yeah.
God that future was curtailed where it was. Because to your point, like WeWork made owning office building, I mean, the pandemic made it worse than that, but still, like, all of a sudden everyone has to compete with free.
But guess what? It
There's
could
this
have
quote,
been.
I read this quote recently. It was from the early 2000s, and the quote was, AT&T laid off 50,000 workers chasing WorldCom's phantom profits.
Yeah.
Like WorldCom was creating fake profits, and AT&T's like, we have to match them. How do we match them? Lay off all these workers. So that's when like a bad business
But
can
streaming-
push a good business
Streaming
to do
is a
terrible
perfect
things.
example. Look
Yeah.
what Paramount did and Warner Brothers and Disney chasing Netflix. They
Yeah.
all did.
Yeah.
Well, and ESPN announced they're going to do a direct stream of their service. I read today just on the way over here. And I was thinking, the thing about ESPN's model is they got paid a subscription fee for everybody who had cable. And you could not charge enough to just the users that watched ESPN. And so it was a little bit like in the newspaper ad days. I used to say, okay, newspapers lose their ads, just raise the subscription price. But if you're making $4 on your ads, you can't raise the paper price to $4. It was like there was no way out. And
So even if you're worried that the worst is yet to come in the economy, and I agree with you, on balance though, it's still probably bullish that there is an interest rate again.
oh yeah,
Yeah,
oh
well,
they're
absolutely.
better.
There's
Yeah.
a cost of capital more important
I
than
think
that.
it would be great if for the next 5 or 10 years, interest rates average 5%. That would be, it would be
It'll
great.
probably limit the amount of SPACs.
Yes.
And I think
Right,
we would all be
that's
okay
okay.
with that.
Yeah.
We would all be okay with that.
Yes.
Do you know how Elon Musk talks about how Hitchhiker's Guide to the Galaxy was the most important book he read? He used to talk about because you realize that asking the question is sometimes more important than the answer. And
Yeah.
But there's a scene in that book that he's never mentioned, but reminds me of this is this hapless sort of our descendants crash land on Earth. And this visitor says, well, everybody seems so happy. And the guy says, well, we told them that leaves are money. And so they all suddenly feel very rich. And they're walking around with leaves stuffed in their pockets and they all feel rich. And you realize, well, of course, this is going to end badly.
Yeah.
But for the moment, everybody feels rich because all those leaves are money.
That was
We did,
2021.
and we literally did that. Did you have fun on the show today, guys?
That was good.
Yes?
I was just here for moral support for Chris.
No,
I didn't
you
say
were-
much, but that was great.
I was a little nervous at being my first time.
Wait a
at all.
minute. You have a podcast.
Yeah.
So,
How's that going?
so if people
It's
are
good. I
like,
just
I
don't know
wanted
what
to
I'm
hear
doing
more
with
of
it.
Morgan, let's tell them how they can do that.
I have a podcast now. I had been thinking about it for years.
Now, what
and
is it called?
I haven't really named it yet, so I call it the Morgan Housel Podcast. I'll change
creative.
the name eventually. Yeah, it's like the Dave Matthews Band.
Oh, you know what would be a
Very
cool
creative.
name for a podcast? The Joe Rogan Show. You should maybe do that.
But I've been thinking about it for years because that's naturally what people like we do. And Patrick O'Shaughnessy called me up 2 months ago, and he just said, "What is it going to take for me to convince you?"
And to get you on
What are you gonna do?
Colossus.
And it was that may have been part of it too.
Yeah.
But I recorded the first episode an hour after that call. It was like the kick in the
Now,
ass I
you're
needed to
doing
just do it.
mostly COVID conspiracy theories?
That's it. It's mostly
Okay.
COVID conspiracy
How's
stuff.
that going?
No, it's cool. I still don't know if it'll
No, but what
last,
are you
but it's-
doing? You're doing your stuff, which is what people want to hear from
Yeah,
you.
it's mostly riffing off of old blog posts that I wrote.
But most people have not read them. So
Right, because I think the overlap of audience of people who read blog posts versus listen to podcasts is actually not that big.
Yeah.
So if I'm just repeating what I already wrote, I think that's actually a great way to
and
do
also
it.
the stuff that you write about, as Chris mentioned, it's like timeless stuff.
It's timeless,
It
yeah.
always matters.
The audio book of Psychology of Money outsells the physical book 2-1. It's
Wow.
like listen, which I never in a million years, because I don't listen to audiobooks.
You have a good,
I
you have a
listen-
good voice, though. You
So
have
do you.
like a
Thank
good
you.
presentation.
But I never in a million years would have thought that because I read physical books. So I was just kind of blind to the fact that way more people prefer to listen. And you and I were talking about this
You
earlier.
just did a not to brag.
It's when
I read physical books. You did. Do you?
I only read
Do you
the
read those
classics.
behind you?
No, go on. I'm listening.
In
No, I
Latin.
never read any of these.
You and I were talking about earlier about how people multitask now,
Yeah.
more than they used to. So they don't sit down for an hour and read a book. They listen to an audiobook while they're doing the dishes.
I
or
can't.
drive a
I
ride.
can't single task anymore. I'm
Yeah,
incapable.
I get it, and that's probably what social media did. To
I
us.
cannot
we
do
can't
one thing
just
at a
sit
time.
down and you've talked about this too. It's the same for me. If you try to sit down and read a book, you got to put your phone in another room. Or every other page, you got to check Twitter.
You can't have children in your house and sit next to them reading a book.
No.
It's almost like it should be illegal. Like your kid's impression of you should not be, my dad is more engrossed in this piece of cardboard than having a catch with me or kicking a soccer ball with me or asking me how my day was.
Yeah.
You really can't do that.
Charlie Munger used to say that his children thought he was a book with legs.
Right. So listen, that was his choice. Like with all due respect to anyone that is like trying to read 3 books a month with kids in their house, I have to tell you, I think you're going to regret it.
It's a hard thing. Yeah.
I would actually say that it's I say this going, I think it's actually a better thing than looking at your phone 75 times.
That I agree with.
Because
if it's the choice of book or a phone, let your kids see you reading a book.
Yeah,
I agree with that.
Because at least they're getting a story. And they learn in stories, they think in stories, but boy, that idea of the parents always checking their phone when they're with their kids.
This might be completely wrong, but is there any logic to if your kids see you reading, they're going to be more likely to read themselves?
No, they're going
Probably
to be like, nerd. Well, one thing about Patrick, and he tells a story about Jim, his father, anytime Patrick O'Shaughnessy had a question, his dad would point to the bookshelf. And he must have had a huge bookshelf.
Look it up.
But this is pre-internet, I guess, or early, but he said, there are the books, go find the answer.
Yeah.
And obviously Patrick is a superstar, probably in no small part because of that type of upbringing. So I don't want people to think I'm anti-book. I'm just saying.
Oh, Philistine here. I had no idea.
You will have plenty of time to read a million books when your kids are out in the world as their own people.
That's good advice.
Is the way at least that's why I stopped reading.
But if you're listening to podcasts while you're doing dishes, going for a run, commuting.
Oh no! Now I
be.
listen to podcasts while my kids try to talk to me. It's way, it's way better. All right, we're gonna do favorites, and we're gonna let you guys get out of here. And this was so much fun. I could have stayed in this room for another 2 hours. Like truthful, I don't know if you guys feel that way.
I feel like we just started. Barely got to anything.
Favorites is where we tell the audience about a book or a podcast or a movie or something that they might have missed. And
I'll start as an example.
As an example, Michael really likes Succession. It's a show on HBO.
No, Citadel, the market maker. I'm enthralled by them. No, there's a show on Amazon Prime called Citadel.
I haven't watched it yet.
And
pitch it. What is it about?
I'm going to. It's
hedge fund.
It's spy, CIA, espionage, Jason Bourne. There's memory loss. And I just found out that it's only 6 episodes, which in my mind, you get like a 25% premium for that. I want to be in and out. There's almost no reason for a show to be 8 to 10 episodes. Anything they can do in 8 could be done better in 6. So Citadel on Amazon. It's good. It's good enough.
Sopranos used to do like 20 episode seasons.
Yeah.
Who has time for that these days?
All right. What do you got?
I'm a big Ken Burns fan, and I learned a month ago that there's one a documentary he wrote that I had never heard of. It's called Horatio's Drive. And I think it's one of his best, but nobody's ever made no.
What is it about?
In 1903, there's a guy named Horatio Nelson who was at a bar in San Francisco with his friends. Cars were brand new. It was still like this, like, oh, have you heard about cars? It's like no one was using them. There were really no roads. And Horatio Nelson said, I'll bet you $100 I can drive from San Francisco to New York. Okay. I bet you I can do it. And his friend put down $100 and said, deal, let's do this. And he did it. And it took him over a year to do it. And the documentary, it's crazy. Like an hour outside of San Francisco, his tire pops, and he has to cable the car company and have them send a spare tire by train. And he just sits there for, and the whole journey across the country is that. It takes him over a year to drive across the country, but he does it.
Pre-maps, pre-roads.
Everything.
Pre-everything.
And pre-maps, the amount of time that he would have to backtrack, sometimes for a week, because he just got lost in the middle of nowhere. He's in the middle of Nebraska on some horse and buggy trail, and he gets lost and has to turn around. It's an amazing story, and it's a hilarious story. It's him and his dog, Bud.
How do you watch it? What is it? What streaming service is it on?
So this is another thing. On Prime Video, for $2 a month, you can have every PBS documentary, which there are thousands of them that are so good. It's $2 a month. That was a good one, too.
Very cool.
You don't want to mute your computer?
What? Yeah, it's not my computer. You know what it is? My phone audio is going through my computer.
What is happening?
I don't know. I'm sorry.
Phone audio through the computer.
I blame John and Duncan.
By the way, you know who else drove across country in the 20s was Eisenhower. And it was part of his inspiration for creating
build the highways?
the highway,
Yeah.
interstate highway system. Is he couldn't believe you get from one state and there's no certain connectivity and this anyway.
Well, if not for the interstate highway system, we wouldn't have had the bank robbers in the 30s,
Yep.
which then you needed to create the FBI for. You have a favorite for us?
Well, I mean, I will shamelessly plug every one
Psychology of Money?
Morgan's books, but if you force me to go outside of my comfort zone, the only other book I've read recently that I found very useful, but it's a different type of book, was a book called Americana, and it was recommended to me. I think it may have been by Charlie Munger, but I can't remember for sure. But somebody had recommended it. I ordered a book called Americana from Amazon. I read it, beautiful reviews, a Nigerian immigrant, and she's a hairdresser, and she goes back to Nigeria. And I went back to the person that had recommended it. I said, it was a beautiful book, but I'm surprised it didn't seem like your style. And they said, well, what do you mean? It's a history of American capitalism. I said,
you brought the wrong one?
I brought the wrong one. So this is Americana. I think it does not have an H on the end. The author is named Boo Srivanasan. Okay. And each chapter is the history of a single industry that was part of the formation and creation of where we are today. So it starts with the Mayflower Compact, it ends with the internet, and it does semiconductors, highways, canals, cotton gin. And what makes it so good is each chapter stands on its own, and each chapter also talks about who financed it and how. Like, did people get rich on it? Was it a government program? Often the inventor got nothing or sold it out cheap.
I'd love to read
So
that.
it's a fabulous, fabulous book. And he's a very interesting, articulate guy.
So I'm going to use my favorite to just play something very quickly.
Live in is one of market share and margins and profitability and things like that. My philosophy is kind of very simple, and that is that I've been on the Forbes 400, I think, since it started. And if you look at the list of people on the Forbes 400 and you eliminate the people who inherited the money, everybody else went left when conventional wisdom said go right. So Fred Smith was a kid at Harvard, and he'd inherited $14 million, and he'd written his doctorate thesis on a concept called Federal Express. And he invested $7 million and got the company started. And then the guys who managed it went back to him for the second $7 million. And he got to find out how much he really believed and how much he wasn't paying attention to all the people who said, interesting idea, but it'll never work. And the rest is history.
So you know who that is?
Sam Zell.
Very good. He's got a pretty distinctive voice,
Do you
right?
know? You heard the news.
Well, this is not completely out of
Okay,
nowhere.
I thought it was. This is going to be awkward.
So we want to say, wait, what? Sam Zell, 81 years, 81?
Yeah.
Okay, Sam Zell, 81 years old, legendary investor, passed away today. Today's Thursday. Did you ever meet Sam?
Oh, yeah.
Yeah?
A number of times.
What's the best Sam story that I haven't heard? Let's start over. Did you ever meet Sam Zell?
I met Sam Zell at a bunch of conferences
Okay.
over the years, and I just loved that he was always iconoclastic.
Hey, did he tell any great
independent.
woodcutter stories? No, he's kidding. All right. So I just thought what was really interesting about Sam is he's the one guy, not the one guy, but like think about how many people in an asset class, almost like he's become synonymous with an asset class. He was the founder and chairman of Equity Office Properties. He sold at the top. Like he did the thing that almost no prominent investor who came to become synonymous with their asset class was able to do.
Yeah.
And in 2007, when the whole globe was clamoring for office properties in Manhattan, he sold it to BlackRock. And I think they like what they got out of the deal, probably not the timing, but he did it. I mean, that's pretty impressive stuff.
And always so independent in his thinking and is so exuberant in his life and his storytelling.
Yeah. And he has a lot of great, really memorable lines. So for my favorite, I'm going to recommend people Google this. Trent Griffin collected some of Sam Zell's greatest hits, things he said, things he's talked about. It's a blog post, and it's called A Dozen Things I've Learned from Sam Zell About Investing and Business. So you can find that via Google, and highly recommend spending 10 minutes reading that. Okay, we had so much fun. We're going to wrap it up here. Want to thank Duncan, John, Sean, Nicole, Rob, everyone behind the scenes who does so much to make the show happen each week. Special thanks to our guest, Chris Davis, Morgan Housel. You guys are, where do you want people to follow you, if at all? Twitter?
I'm still on Twitter. I know you're not, but I'm still on Twitter.
Are you at Morgan Housel on
That's
Twitter?
it. Yep.
And Chris,
Okay.
you're on TikTok?
Chris, TikTok mostly? At
Is
Chris
that the one where you
Davis,
swipe? I'm
6969.
not so current on this.
Okay. All right. You guys are awesome. This has been such a treat. And
been
thank
fun.
you guys so much. And to the viewers, if you like what you heard, make sure you leave us a review. A rating goes a long way. We have to trick the algorithms into believing this is actually a good show. So please help us out. Everyone have a great weekend. We'll talk to you soon.